A few days ago, I made a video on Netflix saying that the stock was setting up for something big and that I was finally buying shares. Then we jumped to today. Netflix reports earnings. The numbers actually look really good, very strong numbers, and yet the stock still crashes. So, what just happened here? Because this sell off isn't about weak demand or subscribers falling off a cliff. It's about something much deeper that the market is suddenly pricing in. And if you're thinking about buying Netflix after this drop, you need to understand this first. Obviously, let's get to the basics. Netflix is still the king of streaming. Over 325 million global paying subscribers across the world. They have strong pricing power, massive scale, and increasingly diversified revenue through their ad and licensing deals. As we could see here, their revenue grew by more than 2.5x from 2024 in terms of the ad tier. But Netflix is no longer being valued as a hyper growth company, which is, I think, the main problem with this earnings. It's starting to be valued like a mature media company, similar to a Paramount or a Warner Brothers. And that shift is exactly why this earnings reaction has caught a lot of people off guard, and why I think that this is something you need to analyze really quickly. So let's start with the part that everyone expected to be bad, and honestly it wasn't. And this is the financial overview. The revenue came in very strong at 12.05 billion, an increase of nearly 18% year over year, exceeding the consensus estimate of 11.97 billion. Also, subscriber growth was very solid growth year over year, up to 325 million, as I was saying earlier. Margins are holding up, which is what I was saying we needed to focus on for the stock to go up on earnings. And the margins did go up, but there is two other reasons why the stock has gone down. But the margins still, with an operating income of 3 billion and margins of 24.5%, this is still great numbers, and it's strong for this type of business. So the free cash flow also continuing to grow to 9.5 billion, up from the 6.9 billion in 2024. So on the surface, this was a very good quarter. Not perfect, obviously, but clearly not disaster level earnings. If this was just about the earnings, then Netflix stock would not be down like this, which tells you immediately that the market is reacting to forward looking risk, not backward looking numbers. Because obviously, this quarter's in the past, but we're looking into the future, and that brings us to the real issue here, and why I think that the stock is down, and it will continue to probably drop for a couple months probably, but there's still a lot of potential here. The main reason why Netflix stock has sold off today is the Warner Bros. Licensing deal. And obviously, we know on paper this sounds super bullish. I mean, more high quality content, more recognizable IP, more engagement. But Wall Street doesn't hear the same type of opportunity, especially when Netflix is willing to pay all cash at 27.75 per share to provide greater certainty to Warner Bros. Shareholders, which is near a huge move, and it's super expensive. And obviously, the market does not like this. Investors do not like to hear cost pressure. This deal signals that Netflix is leaning back into expensive third party content at scale. The market thought Netflix was past this type of phase. They were focusing on efficiency, originals, and disciplined spending. Instead, this deal suggests that Netflix is willing to pay up again to defend engagement and retention, which is obviously a net negative for the stock. As we can see here, some of the main things that I have down as the main drivers for this decrease in the price is that they have departure from organic content, and Netflix has historically relied on organic growth by building their own names like Stranger Things, Peaky Blinders. They build these names up and they make them something that's a trend or it's famous, and not buying out companies that are already existing that have huge moats. Also, this poses a huge risk because of the significant debt that this brings on. The all cash offer requires Netflix to take on substantial new debt of up to 59 billion, potentially bringing the combined company's total debt to around 85 billion dollars. The increased leverage and borrowing costs, especially in this type of environment we're in, this economy we're in, it could be a huge risk, especially with anything could happen at this level. And And with the deal expected to face significant antitrust reviews, I mean, this is pretty much creating a monopoly for a company like Netflix, which is constantly growing quarter after quarter. And I think that there will be a lot of issues for this type of deal going through, whether it goes through or not. But they are in the earnings report. One of the key things that they pointed to was that they are focusing on next year is closing this deal, which is why I think that the stock has continued to decrease. Also, a lot of analysts have expressed concerns about the ability to successfully integrate the two businesses and realize the projected 2 billion to 3 billion in annual cost savings. Additionally, some analysts worry that acquiring traditional studio operations exposes Netflix to risks from disruptive technologies like generative AI. And these are all true points that I haven't really even looked into, but I do agree with many of them. And here's the key fear. Once Netflix starts relying more heavily on major studios again, then margins become harder to control. You're no longer just competing on product. You're negotiating against powerful content owners who know the value of what their services are and what their content is worth. And that changes the long term margin story for a company like this. And the market does not like uncertainty around margins, especially in the type of economy we're in right now. Another thing I want to point out is what that they put into the the earnings report today, and it's the second piece of bad news is that Netflix also guided to roughly a 10% increase in content spending, which on the surface, obviously this is not inherently bad thing. 10% growth to 20 billion, it doesn't seem like a big jump, but content is Netflix's moat. You can't grow without investing. But timing still matters. The market was expecting a lot more operating leverage at this point in the company's uh, base, and now reaccelerating in spending is something that I don't think a lot of people were expecting to see, and I think investors were looking to see the company moving past this, especially with the type of company that is growing here, and with the higher content budget combined with the Warner Brothers deal. This tells investors one thing, and it's that Netflix sees competition heating up again, and this is by a long shot, especially as we know there's a lot of names in the game right now. There's Disney, Amazon, Apple. Everyone is spending a lot of money trying to break through into this market. So Netflix is choosing offense over margin expansion. And in this market, that often gets punished because people want to start seeing just consistent results and how these numbers are affecting the stock price on a daily level because they are continuing to post good numbers, but the margins are not improving, which is obviously not a great sign, especially with all the things going on. So here's why I think that the market may be overreacting. Netflix still generates massive cash flow, as you can see here with the earnings report, 9.5 billion in free cash flow, which is more than it's ever been. They also have strong pricing power, and this just comes to show after the daily signups, which have continued to increase despite the policies they've implemented, which people have said, "Oh, this is going to kill the company. This is going to stop the company's growth." Their pricing power is a key driver of continued double-digit revenue growth and expanding operating margins, with revenue of 45.6 billion in 2025, and the forecasts for this year are also great. They also still dominate global streaming. I mean, if you're looking at streaming, it's going to continue to grow year after year, and they now have 325 million paid subscribers. So this sell-off isn't saying that Netflix is broken, in my opinion. It's saying that Netflix might not expand margins as fast as Wall Street has hoped, and that's a valuation reset, not a business collapse. The underlying business for Netflix is still intact, and historically, these types of reactions to earnings often create a lot of opportunity for long-term investors who understand the difference. And I'm not saying to invest right now, and this drop does not make me bearish on Netflix in any way. It doesn't change anything I said in the last video, but it does change how I buy it. This is no longer a chase the dip blindly setup. This is a scale in, a patience required situation. You're going to have to scale in slowly. If Netflix proves they can absorb higher content costs while maintaining cash flow growth, this stock will recover very quickly. If margins stabilize faster than expected, this drop will also continue to look like it's going to continue to increase, as the margins is the main thing I think that the market has focused on this year. I'm watching how content spend translate into engagement and pricing power over the next few quarters, especially as it grows to 10% increase. That's the real story right now. I think the engagement and all this stuff is going to be what they're watching. All these margins is the main story here. So the truth about Netflix crash is simple: earnings good, but guidance changes the narrative here, and Warner Brothers is a huge licensing risk. Higher content spending is a main driver for why the stock is down, and margin uncertainty is obviously going to continue to spook the market. And this is not panic worthy, in my opinion. It is just a buying opportunity, but it is something you need to understand before buying. If you want, I can break down exact price levels I'm watching next. I hope you guys enjoyed the video. Drop a like, drop a sub. All your guys' support has meant the world for me recently. Thank you guys for watching. Peace out.